In this video, we're going to look at 5 growth stocks that you might want to consider investing in or having on your watch list. Coming up today on Investing Education with me, Mr. B. Welcome to the channel where we help you to learn fast so you can become a confident and successful investor. If that sounds interesting to you, do consider subscribing. All right, let's take a look at 5 growth stocks that might be of interest to you, and let's look at those in detail. Now, one quick disclaimer: I am an educator. I'm not your personal financial advisor. I don't know your personal financial situation. So consider this more education, some things to consider, as opposed to direct, financial advice. All right, so it's more for education. The first one to consider here, and they're not in any particular order, is PayPal. All right, so PayPal, you probably might know them, you might even use them. And why they're a strong growth stock is they're still growing. Even though they're very big and very solid, they're still considered a growth stock. And actually their stock is down in terms of price a little bit here, at least when I'm recording this. We're going to take a look at some of the ratios and numbers. But if we think about PayPal, one of their big strengths is they're approaching or are now over 400 million users. So you think about that tremendous user base that they have, and they have really loyal customers and loyal users to PayPal. People who use PayPal tend to really like PayPal. And that also ties into their strength in terms of their brands. They have quite a few different types of brands. We're taking a look at it here on the screen. You might recognize some of these brands beyond just the PayPal processing transaction app on the internet. Some of these different brands that they have, you might not even know that they actually own Venmo, or that they own Zettle, or Honey, which is a discount couponing site. They own all these different types of brands, and they continue to add brands, and every time they add a brand or expand, they've got that built-in user base. A good example of that is PayPal Crypto, right, where you can buy, sell, or hold crypto with confidence, as you can see on their site here. And they just launched that not too long ago, and they've got a few coins: Bitcoin, Bitcoin Cash, Ethereum, and Litecoin. Wouldn't be surprised if they start adding more cryptocurrencies to that as well. I have a whole video actually around PayPal and PayPal Crypto, to check. You can check that out, or go to my homepage on YouTube to check that out if you're interested in learning more about PayPal Crypto. There's strengths and weaknesses to PayPal Crypto if you want to use that service. But the fact that they've got 400 million users and can now expand into things like the cryptocurrency space, gives them a real leg up as far as, building out these businesses. So that makes them a good growth stock as far as having some strong brands, a big customer base, some customer loyalty, and the ability to, expand into some other areas here. Let's take a look at PayPal as far as some of the numbers, as far as, investing in them or considering investing in them, beyond some of the strategy and some of the things as far as this growth stock. So I just popped over here quickly to Yahoo Finance. Let's put in PayPal. There's PayPal Holding Company, PYPL. You can see they're down a little bit today, but let's take a look at their company. And one thing is, they've been trading down. You can see in their 52-week range here, from 179 to 310. Currently, they're around 188. So they're at the bottom end of their range. If we look at the last year on the chart, you can see that they're down. So they have been down a little bit as far as the stock goes. But there's some interesting things here. They have a high PE ratio, price earnings ratio, like a lot of companies do who are growth-oriented companies. And being a growth-oriented company, you can see the dividend. They don't pay a dividend. So that's a very common thing, again, for growth companies, more technology-oriented companies, as a financial payment processing primarily company. But if we look at some of the statistics and some of the other numbers, there's some interesting things. Why they might be advantageous right now. One is their PEG ratio here at 2.11 PEG ratio. PEG ratios is looking at your price to your relative to your earnings with a growth factor in that. And with a PEG ratio, and I like the PEG ratio, if you find anything under a 1.0 and a PEG ratio, that's a really great opportunity as for something to identify as a buy. PayPal, as far as growth stocks goes, not too far off. They're at 2.11 here. So, not a bad price earnings growth ratio as far as getting into something that's a higher technology stock for growth. And if we look at like return on equity at 24.3, ROE, if we have something over 14%, that's considered good, and they're at 24.3. So a couple a couple good numbers in there. In fact, their beta, which is a 1.16, beta is a measure of risk. A 1.0 kind of matches the broader market, matching the S&P 500, the broader U.S. stock market. So if we think about things that are risky, typically, real high growth or high tech stocks or technology stocks or newer stocks might have a real high beta above 1.0, well above 1.0. Being at 1.16, it kind of follows along with the market. And you can see the 52-week change, they're down 19% compared to the broader market up 26% at the time of this recording. So you can see there's actually some really good upside as far as the potential for PayPal, a well-established brand. So, PayPal is one of our 5 that we might want to consider, and those are a couple numbers to take a peek at as far as doing your own due diligence looking at PayPal. Another growth stock that's been underperforming as of late is Teledoc. Teledoc was a darling stock during 2020 during the pandemic. Teledoc is all about video communication and video basically doctor visits is what they are. And so that's what they do, is they provide this video services where you can, talk to a doctor over video conferencing. And they have competitors in that space. Zoom is looking to get into that more, as well as some other types of competitors. And they really went way up in price as far as during 2020, during the, the peak of the COVID pandemic. But they're still around. They still have great potential as we move from more in-person medical visits to more virtual medical visits, and that's overall a growth area. But their stock has definitely been beaten down as well too. If we take a look at their, and you can do things like with Teledoc where it's like, I think it's like around $75 for a visit. So for people who are not have insurance, particularly in the United States and some places, there can be advantages there to, to have some health coverage as just a health visit. But this would definitely be a more riskier play for sure. So if we look at a couple of their numbers here with Teledoc, as we saw, their price is very low here. They don't have a PE ratio yet because they're still not earning money. See, where PayPal was having profitable earnings, Teledoc is a younger company, still trying to grow. You can see their earnings per share is a negative 5.45, right? So they're still very much an early growth phase. So this would be a kind of a company if you're looking for something with some early growth numbers. One thing that was interesting with them, if we take a quick look at a couple of their numbers, is one is like looking at, let's say, like their price to book, right? So price to book is kind of a value rating. So if you're a value investor like Warren Buffett trying to buy stocks on sale and things like that, anything that you can find below a 1.0 in a price to book is kind of telling you that the price for the stock you'd pay is actually less than the assets that they own. It's very rare to actually find, particularly with growth in technology companies that have a price to book under 1.0, they're usually trading much higher multiples at a premium. And as you can see here, the price to book on Teledoc, because their stock price has come down so far that they're at a 0.94. So value investors are looking at that and saying, is there some great growth potential here? Is this thing just going to be a falling knife? Is this just going to flame out, or is there some potential here? So that's where that below 1.0 is very good. So Teledoc might be one to consider. Another growth potential stock is Twitter. Twitter just had some recent things that were some big news around that. Let's go on back over to Yahoo here. We'll look at some of the numbers, a little bit about Twitter. You can see they're also having a down day here, but that's just the day. But the big thing in the news with Twitter is, that Jack Dorsey, the CEO of Twitter, is stepping down, or has stepped down. Their chief technology officer internal to the company is taking over. And for many investors, they think of that as a good sign. Jack Dorsey is the founder of the company, but if anything, he also involved with Square, which has recently changed their name, and he was considered to be more in the investing community, or for a lot of folks would consider him a part-time kind of CEO. He's just involved in so many different things. He's involved with cryptocurrency. As I mentioned, he's got Square, he has Twitter, and he was just kind of pulled in a lot of directions, right? And he launched a successful company, has made his millions, he's set for life. But he is stepping down, or has stepped down as the CEO of Twitter. And so a lot of investors might be thinking this might be a good opportunity when a founder steps down and now the company can grow and be managed differently. They do have an internal promotion with their chief technology officer taking over, so it'll be very interesting to watch with that. But Twitter, has been really down in terms of price. This is another one where it's trading near its low. Here's 43.13 on Twitter. Their 52-week range here is around 41.01, and you can see they peaked out at 80, right? And they've had some profitable quarters, but right now their PE ratio and their PEG ratio is NA because they're having some negative earnings, right? They're negative earnings per share. So if they can turn that negative into a positive, that's a catalyst for a stock possibly to rise. And one thing that's interesting with Twitter is where they're offering a subscription service. They're testing it in the United States. They're going to test in other places where it's like $2.99, but then you can avoid advertising is the idea behind that. And that's a very unique thing, or a very interesting thing because, companies like Facebook, which is now called Meta, but you think about Facebook, Instagram, all these different social media platforms, Pinterest, they're all driven by advertising and they're all driven, by offering it for free to their customers, or which are really their product. You and I are the product of Facebook, and then Facebook sells that product, us and our data, to advertisers. Well, Twitter has things where they're experimenting where they can still have their free version of Twitter and have all those ads come at you, and sell your data, or that you can sign up for looking at a subscription service where you can kind of get out of all that. So I think for social media, that is an interesting type of play. You see that actually with YouTube, where you can avoid ads by, of course, subscribing to YouTube. So I think that's a very interesting thing to watch for Twitter. Again, trading near its low. Could these stocks go lower? Sure, all of them could go lower for sure. But there's an opportunity there maybe to buy low and then later sell high. It's an interesting stock to put on your watch list. And you can see, price to earnings, they have high price to earnings, a typical social media, technology stock, though they've been struggling with their earnings as far as that goes. And if we think about Twitter, that's the main thing with Twitter. First is as far as can they turn profitable, and how can that subscription service to look at? Price to book is is higher at 5.8. It's not like a Teledoc, right? Price to sales is actually very good. At a 7.56. Anything in price to sales of over 4.0, below 4.0 would be good. You want a lower price to the sale, so that's actually high. My apologies there. So it's actually a little high. But look in comparison what the price you're paying over over the period of time, up in the 10s and the 12s, so that you're getting a technology company at this low price to sales is not bad. Again, it's technology. It's still a growth stock, so you still are paying a premium in there. So some things to consider, but there's a lot of uncertainty around Twitter, so that's one thing you'd want to consider as well. Another growth stock to consider is Amazon, right? Let's pull up Amazon here. And with Amazon, you're not getting something at the low end, right? You're not getting something trading near a 52-week low. This is betting on a dominant player in its area, in multiple areas, and that it will keep continuing to grow. You can see it's 33.77 right now. And if you have a stockbroker that offers a brokerage service that offers like fractional shares, I have a whole video around fractional shares you can check out as well, where you can buy a portion of it. Maybe you're buying 10% or 1%. It makes it much more affordable. So check out if you have fractional shares available to you. Not all brokers do, but many do, and more are offering all the time. So check out that video. Check out fractional shares. But with Amazon, I mean, you can see it's right above. Actually, it's trading right now above its 52-week, or right in that 52-week range, at the top, right? So you're picking something that's at the kind of the tippy top as far as what Amazon would go. And the thing about Amazon, if we look at a couple of their statistics, I mean, you can see their price to earnings are just crazy, right? 66. We're average for the S&P 500 is like 16. For example, if we look at their PEG ratio, right, you want something below 1.0 would be great. But the thing with Amazon, it's 2.05, not below 1.0, but for tech companies, especially big dominant tech companies, that's actually not too terrible as far as that. And it's also with price to sales, as far as you want something under 4.0 ideally. Under 1.0 is tremendous, but around under 4.0 can be a good number. 3.86, that's not too bad as far as the price you're paying for all the sales that Amazon generates. So you can see just a massively high price to book, 14.49 as far as price to book. So Amazon is a dominant player And one thing, if you look at it from a strategic standpoint, that Amazon does well, that's very interesting, is they actually take cost centers and turn them into profit centers. So this is very interesting. You think about, well, what do you mean by that? Well, look at the Amazon, their whole e-commerce, all things driven by, the web, right? People go and buy products, they're e-commerce, right? But then they create Amazon Web Services to provide that service to others and makes it into a huge and highly profitable profit center for them, as opposed to being just strictly an expense for them. So you have Amazon Web Services. You think about what Amazon's investing in with delivery, with their own delivery trucks and their own delivery services. This is something that they can grow and turn into possibly a profit center for them, and in addition to reducing their costs by doing it themselves, versus, let's say, farming that out to FedEx or UPS or other service companies. So Amazon would be looking at the opposite end, where it's towards a peak, but a dominant long-term growth player. And the last one to look at here is Airbnb. Right, so if we look at Airbnb, an interesting thing. That's where, of course, you rent out people can rent out their homes as far as Airbnb would go. And with Airbnb, the thing that's interesting for them is, from a strategic standpoint, is you think like, okay, the pandemic would just really crush Airbnb, but the thing that they can do is they can adjust their expenses easily up and down depending on what the market and what's happening in the broader market. And what do we mean by that? Well, because they don't actually own hotel properties like a Hilton or something like that, they're using other people's services. So with these side giggers, people are renting out their through Airbnb their places. Airbnb doesn't have to maintain that very expensive physical property inventory. So if sales are down, well, they can adjust their expenses, they can go down. When things are booming, you'll have more people bringing on properties. It gives more opportunity to share in that side gig economy and share into that sharing economy. And Airbnb is a real leader in that. VRBO or Vrbo is another one, but Airbnb is very interesting. You can see they're also having a down day in Wall Street, but you can see in their 52-week range, they're kind of in the middle, right? And they can be real sensitive to things that are happening in the broader economy. Things like around inflation might be impactful. If people have less money to spend on, let's say, leisure, that'd be something to look at as well too. They don't have any earnings, because they're still, again, a growth type-oriented company as far as how Airbnb would be. So they're, again, all about, more so, though they're looking to be profitable, that's where this forward-looking price to earnings ratio, that they're going to start turning a profit here, they expect here soon. That's really what that's talking about here. No dividends or anything like that. So Airbnb would be more of this, again, more of that long-term growth type thing would be the idea of looking at that. So so that kind of wraps up here as far as some companies to put on your watch list, maybe consider. You've got some trading near their lows, PayPal, Twitter, trading near their lows, certainly Teledoc. You've got a big dominant player like Amazon that you can consider, and consider that paying a premium, but you got that dominant player. And then you've got somebody like Airbnb who's kind of in the middle and just still emerging and going from being a private company to a public company and being in that emerging type space. So some ones to consider. Again, it's all your decision. Do your due diligence, look into it closer, but there's 5 growth stocks that you could start considering right now.